So let's talk about that, right? So as we saw, the biggest thing that we can do two simple things. Number one, reduce the income level, and number two, push and qualify some of your other income outside your W-2 long term, right? Money that we earn most expensive, money that our money earns is the least expensive. So let's take a look at it. Money that we earn, we're trading time at the highest tax bracket, right? Money that our money earns, typically the lowest tax bracket, long-term capital gains, that investment coming through. So between those two, you can optimize what is your tax bracket. Is it 25%? Is it 35%? 10% makes a lot of difference, right? You can go buy a new car or take a 2 months and a vacation, right? Or you can invest in a multifamily or anything with that 20, 30, $40,000 of additional, cash that you don't have to spend. So all in all, the possible strategies: reduce your taxable income, increase your tax deduction, maximize the tax credits, and also timing of income and deduction is very important. Then you're restructuring investment for tax efficiency. Those are all legal, folks. And then what we said that in general, it takes a little bit of time to improve the tax knowledge. But then last, number 7, work with the tax professional. Whoever is your person, go to them, pick up the phone call, schedule some time, and you let them know, hey, this is my 22, 23 looks like, this is my 24 looks like, and what is, based on my calculation, I have to pay X amount of tax. Can you give me some ideas to reduce that X amount of tax to X minus something? And that's your tax optimization. That is worth 5 hours worth of work, 10 hours worth of work for you. And we always recommend go pick up the phone call and go see them. All right. So again, one of the things to remember, if you're in the commercial passive investing, as of now, it's a depreciation of 60% this year, and next year is going down to 40%. That is the rule. We're not going with the side of emotion, what's going to happen, not going to happen. There's always the likelihood of that changing a lot, but we don't know. So we always say stay close to the market. So if the market goes high, you go higher. And market goes low, then you don't go that low with the market, right? So position yourself, bank it as much as you can, and then when the time comes, we'll write the upside if there would be any. So now what we're going to do, we're going to turn that into the source of capital, right? So first thing is understanding our income, then understanding our income level, and then we're going to talk about understanding our source of capital. Source of capital means, let's say we have $50,000 to invest, or $100,000 to invest, or $500,000 to invest. Which bank account is coming from, or which account is coming from, it sets the tone. So in this case, I will shift the conversation into Roth IRA and Solo 401k. And that's what we do most of the work. So Bill, for again, before I get started, I think almost all of our massive capital team, no, yeah, we have Roth IRA for sure. And some of us, we have Solo 401k as well. And there was a typo that I made. I couldn't change that fast enough. Bill, thank you for it. So Solo 401k, Roth IRA, we, us as a team, I think, Trevor, correct me if I'm wrong, between us, our team, we have invested more than 50 times using the Roth and Solo together, or something like that?
Yes, yes.
Yes. So 50 times we deployed money from those accounts. And then we get a lot of questions about tax treatment, contribution limits, UBIT, how does it work for investing in real estate, and who does it best for. So we thought we put a matrix together, so at least you have a version to get started with. Full disclaimer, I have a typo here, so we'll update that. But Bill, would you please take it from here and give us some idea from your perspective, Roth versus Solo, and if I am a W-2, I moved roles, I have some sort of, I have some 401k with, I don't know, with Fidelity, and how do I convert those money into IRA and or Solo 401k to deploy the capital into real estate?
So Roth IRA, it's one type of IRA. So the word IRA is individual retirement account. So if you're married, each one of you would have your own IRA. There's no such thing as a joint IRA. The Roth, it was named after Senator William Roth from Delaware. He created it, so they named it after him. What that means is with most retirement accounts, you get a deduction going in, you pay tax when it comes out. With the Roth, you pay tax before it goes in, but then when it comes out, it's tax-free. So it's pay me now, pay me later. But they allow you to grow your money for income tax purposes, meaning when you ultimately take it out and put it in your own savings account, your own checkbook, it's going to be tax-free. They're more of an individual because for people maybe that want to save on their own, independent of their job. A lot of people that work for a job may have a 401k at their work. A solo K is almost the same thing. Solo Ks are, they also call them like one person K, uni K. Those are 401k plans that are for one person, like you own your own company. It can be extended to spouses as well, but so call it yourself and or your spouse. And so it's a 401k plan, but it's because you have a active business. Now, just saying you want to start a business and one day you're going to sell lemonade at the lemonade stand, that's not an active business. It actually has to be something that is generating revenue and you have the ability to defer cash out of it. You know, you got to grease the skids every now and then. Biggest difference comes the amount of dollars you can put into it. And so actually even now, like the Roth IRAs, they're now up to 7,000 for, people under 50, 8,000 for those over 50. Solo 401k plans, those are now up, in the 60,000s. You get a much faster ability to put it in. The biggest thing when it comes to investing in real estate, both are allowed to invest in real estate as long as it's not real estate that you manage or you control. You don't want to invest your retirement assets in anything that you have management control over unless you just want to automatically pay 40% tax. You invest the money into the real estate. If the real estate, which most do, if the real estate has debt, i.e. a mortgage, when it has a profit, this is where the biggest difference comes between the IRA and the 401k. The profit that is earned from the debt inside of the IRA, and if it's a Roth IRA, if it's an SEP IRA, if it's a simple IRA, if it's a pre-tax IRA, it's an inherited IRA. If it's got the letters IRA after it, the profit will be subject to tax. Now, remember, it's less than 100%, and it's only because you made profit. Think of it as a cost of doing business inside of your IRA. It's just remember, it's whether it's a Roth that's tax-free or pre-tax. One of the costs of doing business in real estate with an IRA is that when it makes a profit, there's a tax associated with that profit. With the solo 401k, there's no tax on the profits made off of a debt. Solo 401k could be Roth or it could be pre-tax. Difference being if and when you eventually pull that money out for retirement, are you going to pay tax on it or not? IRAs also, when they do have those profits and those profits exceed $1,000, they have to file their own tax return. The tax return is called a 990-T, 990T Tango. Solo 401k plans, they file a form 5500, 5500, and that's when they reach 250,000 or more of assets. And so if you have your own business and if that business is profitable and you want to figure out a way how to get some tax deferred earnings or tax-free earnings while using real estate, the solo 401k could be a very good option for you. If you work somewhere else, you've got a job somewhere else, but you've got extra money and you're trying to defer the payment of a lot of these profits on the taxes, then an IRA could be a good option for you. They're all good. And these are just things if you want to use your retirement funds. Now, up until a couple of months ago, that used to be if two spouses, if one was working and had a 401k and the other spouse wanted, say you wanted to get into your money, but you didn't want to quit your job, you used to be able to do something called a QDRO, a quadro. Usually you hear about those in divorces. Well, it used to be you didn't have to get divorced. And so one spouse could actually get the retirement plan from the other account and avoid paying the 10% penalty. They did have to pay the tax, but there's no penalty. Then a judge said, no, that's no good anymore in Texas. Unless you've got problems, you can't get the money out. So the quadro option, there's a few judges in Texas that might still sign off on it, but for all intents and purposes, don't plan on getting that money out anymore. So this is just both very good options, how to invest money. When you think about, well, where am I going to get the money to invest? It's just alternative ways of finding funding.
And then when people, let's even go back a little bit further. So what normally happens is someone has a previous employer and they have money sitting in that previous employer's plan, whatever that type of, whatever it is, they need to move it over to what's referred to as self-directed, correct?
That's accurate. And
Yeah.
so you could have had other IRAs from before, or you could have worked at another company before and you had 401ks and they're still sitting back with the old company, which if there's more than $5,000, they can't kick you out
Right.
unless they close their plan together. But if you have more than 5,000 in a 401k at an old plan, they can't kick you out. You can keep your money there. And maybe it's a good option. Maybe there's good investments there. Maybe the fees are low, but you're stuck picking with what they want.
Yeah.
If you
And
wanted the
normally the
freedom,
fees aren't low, which is why they want to keep your money often.
correct.
The most interesting thing about those is whoever manages them makes money whether they make money or not. Where
That's
when you
accurate.
move it over to a self-directed custodian, it's really, they have fees, they're disclosed, and they're transactional fees, not fees like as if they're managing your money, because you still have full control once you switch it to self-directed. Where do you move your money?
Yep. And there's some excellent IRA custodians that can help you with that self-directed IRA. And then you can pretty much, again, as long as it's not something you're controlling. So if you're going to be a passive investor, you could be a real estate professional. You just don't want to invest in your own deal. Invest in
Right.
somebody else's deal. And then
Yeah.
you can invest that money in somebody else's deal. And it gets you, again, the ability to use those funds. Maybe you want to cash them out now, maybe not. But if say you're like, look, I've got this money, I don't want to have to cash them out because maybe you've got $100,000 and it's $100,000 to invest. I don't know, making up a number. Well, then, yeah, you don't have to cash it out. You don't have to pay the tax today. And while I said there is a UBIT tax, just remember, it's because you made more money in your account. And so they're only taking the tax out of that more money, not the money
Yeah.
that you're rolling over.
And then when you're doing tax planning, and we might talk about this a little bit later, sometimes what you put your money into is an important part of your plan. So for example, if you're investing cash, you would want to maybe put that into something that had a bonus depreciation or some sort of other passive losses. You can't use those passive losses on your self-directed retirement because it's already a tax-free haven. So there are other opportunities, development deals, and we have two different options at Massive right now. One is perfect for your retirement funds. Doesn't mean the other one's not good. It's just not perfect. And the cash doesn't mean cash, and the development one isn't perfect either. So it's very, again, when you're doing your planning, this lesson I learned very hard. I did two investments. One was in development, I put cash. One was in a multifamily, and I put my IRA because nobody told me. And I like, oh, why didn't anybody tell me? I wasted that depreciation.
To kind of build up on that one, it's when I started IRA, I started on the Roth IRA first. I came in from the backdoor perspective, and first 2 years intentionally I leveraged the an IRA to and I paid UBIT. But over time it became an investment vehicle where I had leverage, now it's low leverage, it's low leverage. So UBIT went away. That was a tactical choice, talking to everybody else. And that, hey, I mean, tax is tax, but if I can reduce the tax position, it's better it is. So intentionally, sometime you design yourself to pay that tax now to get ready and save it for later, right? That's number one. And then we talked to Bill, that the quadros he talked about. Thanks to Bill, I have a quadros that I broke from my previous employer into the solo 401k, which I enjoy without paying the penalty. It worked out. So staying close to your tax professional matters a lot, right? Now, on that note, Bill is absolutely right. Sometime when you get into the deal making, we're looking for optimization. There's some optimization you don't want to make. Fastest way to get to somewhere else, get a lot of fee, or when jumpsuit will be when you start breaking all the rules. The rules are pretty clear. Follow the rules. If you don't know, it's a good idea to go with the custodian. That's what the IRA people would do. They look at the transaction, ask a couple of questions. They're gonna keep you in line. Once you feel comfortable, you can go self-administer, right? It's a good one, but Spider-Man, right? With the great power comes a lot of responsibility. It's very similar to that as you kind of go through. But all in all, we believe every investor should have these vehicles, both or one, whatever you may be, but have one and keep and invest from that perspective. I hope, right?
Yeah. One other planning opportunity some people look at as you're looking at your income, and we talked about the different tax brackets, knowing that one day you're going to have to pay tax on your IRA, or if somebody inherits it from you, they will have to pay tax on the IRA. So there's always going to be tax on an IRA. If you're in a relatively low bracket, maybe the 10, 12, possibly 22% bracket, you might want to look at starting to convert some of your pre-tax IRA into a Roth IRA. In other words, saying pay your tax now to give yourself a better tax-free ultimate return on those assets. And in the event that you're a real estate professional with active participation and you're resulting in a overall net loss, which does happen a lot. It's not that you could be cash flow positive and still have a taxable loss based on the depreciation. You might be in a negative situation, which means you're like at the 0% bracket, very good chance to now start converting some of your IRAs into Roth, picking that tax up now, picking that income up now to, again, absorb some of the 10%, 12%, 22% tax brackets.